Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news. That can be a bit confusing, misleading, and take us off course. Now, to make it actionable, understandable, and clear. What a week. What a show. You're going to invite the kids and grandkids into the living room on this one. Tell them to put down the iPads and the video games. So we've got some information that's going to bless them for decades, if they will but listen. 3 points. We're going to be looking at a Wall Street Journal article by John Sindru, helping us identify, are you ultra rich, rich, or merely affluent? It makes a big difference for your bank. I want to try to pull back the curtain a bit for you. I then have a financial advisor article that was hidden behind so many paywalls. But boy, I got to it, and I'll send you the right link. But it says the S&P 500's record rally shows cracks as most stocks left out. I want to get into the mechanics of how index funds work. I hope it's encouraging. That's by Jeffrey Morgan. And then we're going to look also at value stocks. I want us to step into Robert's corner a little bit here. I had a friend that was asking for great books about the 1920s bull market run, and I think this is an intelligent man who I think was trying to make analogies to our present 2020s mania. And so I have a quote from Mr. Jesse Livermore. We're going to do a little walk down memory lane, history lane, and see what lessons we can learn. But let's start here. Wall Street Journal, John Sindru, headline, are you ultra rich, rich, or merely affluent? It makes a big difference for your bank. Subheadline, the mass affluent wealth market is a tempting way for the likes of UBS to gain scale, but the benefits for their core business could be scant. So this article by John Sindru was written in large part as a way to identify how these big banks can make money off of clients and the best way for them to be profitable in their wealth advice businesses. That's not really our perspective primarily, but boy, does it give us insight into the manner in which these banks see you as a client. So one of the great mysteries in wealth management is that the greater your net worth, it's not necessarily the truth that you'll get superior advice. You get superior service, but not advice. And if there are any listeners who have been through the carousel at any of these banks, the article explains this is such a profitable endeavor for these businesses because they have something called low capital requirements. It just doesn't take a lot of money on the balance sheet for these banks to have these businesses. So that's good for regulators. So they say Morgan Stanley has done really well. And they make a ton of money off it, which is quite all right. It yields a 29% pre-tax profit margin. So very profitable part of their business. UBS talks about they have $2 trillion in client assets, only a 12% margin. But these banks are thinking of this as an industry, not a profession. What could the problem be? When the bank is thinking about how to increase their profitability, which they're welcome to do, as a consumer, you're going to really need to be wise as a serpent, innocent as a dove. Mr. Sindru, the journalist, goes on in this article, the financial industry places the cutoff between ultra high net worth and high net worth or affluent at 10 million in investable assets. Below that, in the bracket between 100 grand and 1 million, are the mass affluent. And amongst these stratifications that banks will place on clients, there are perceived benefits at each level. Now, I suspect if you're like the average American, and you're not because you're listening to this podcast, you're special, you're different. But if you were like the average American, you would think, and you would think incorrectly, that if you walk into the bank with $50 million or $100 million, the solutions provided to you and the advice given to you is going to be superior than if you went in with $500,000. I disagree. Now, this is where I should probably invite someone on the podcast to talk about this. I think there are probably unique instances where it would be beneficial to have a unique solution from these big banks, but this article explains these clients pay big bucks for bespoke one-to-one services. Of those, these are the clients, 59% are retired or pre-retired, yada, yada, yada. So the idea here is that, hey, look, we're this big bank. This is exclusive, meaning you have to have $10 million to come here. And we'll have these really unique they use the word bespoke, solutions that are tailored just for you. You won't be with the rabble over there doing kind of what everybody else is doing. We'll do something real unique to you. We'll put products in front of you that we only put in front of our 10 million plus group. Can you feel it already? Can you feel the FOMO? So Mr. Peter Thiel, the famous venture capitalist, author of the book 0 to 1, founder of PayPal, etc., he has a commentary on the industry. He says, when consumers enter an industry and they actually don't understand the product and they don't understand the value of the offering, they gravitate towards brands. Now, we may assume that if someone's worth $100 million, they're really intelligent. They probably are. Doesn't mean they know anything about investing or personal finance. Like, they could know nothing. What do you do? Because guess what? The bank, if you sell your company for $100 million and you put it in the bank, guess what JP Morgan does? Scramble the jets. You're getting a phone call and some tickets to a game and a quiet dinner and hushed voices talking about these bespoke solutions. Not all bad, by the way. I think there are probably plenty of instances where some of these banks will offer perhaps a healthy, creative financing solution, or they will help facilitate estate planning needs. Plenty of things that are profitable for the client, unprofitable for the bank. Ironically, where it's profitable for the bank, I'd say probably unprofitable for the client. So what I want to do is just help dispel the myth that just because, and this article is talking about these levels and stratifications, it may be the case that when you put your listening ear on and you're at the water cooler at whatever establishment, you hear someone say, oh, I was at, here, name the names, Wells Fargo, UBS, Credit Suisse, Raymond James, Morgan Stanley, UBS, whatever, Goldman Sachs. I wonder what bespoke creative solutions they're getting. Let me tell you, my experience, this is one man with a podcast in Dallas, although I think that's worth something, is that the advice ain't great. And when I say the advice ain't great, what do I mean? The temptation for a large bank, when you hand them $50 million, $100 million, is they want to tell you things you want to hear, like, hey, we're going to know when the market's good to invest in and not invest in. Can't do it. Keep your time horizon long, remember? They're trying to in and out. Hey, we know which sectors of the economy are best to invest in. Keep your investing simple. They violate the simple deal. And what they really will violate is keep your costs low, because throughout all this, the rigmarole is there are all sorts, a medley of products, a cornucopia, kaleidoscopic in choice, that are expensive and complex. So you might have your head spinning, not know it till you're 10 years down the line with one of these groups and be in a bad spot. So be willing to keep it simple, even when, as Peter Thiel kind of warns us, even when the gravitation towards a brand is tempting, and it's really going to be, someone makes $100 million, they're, maybe it's elation's their first thought, but fear is their second thought of losing it. And so it is tempting to go hat in hand to one of these big things. I think the best thing you can do is focus on education. So there are a whole host of books. I know I've talked about them a lot, but The Simple Path to Wealth by Jill Collins, A Little Book of Common Sense Investing by John Bogle. I think Morgan Housel's work, all of it is, The Psychology of Money is great, but he's got a whole host of other things to read. If you start there, you'll be in a great spot, and you won't have to go hat in hand. Next up, the S&P 500's record rally shows cracks as most stocks left up by Mr. Jeffrey Morgan. Now, this is interesting. Listen to this. Grandchildren, bend your ear on this one. The S&P 500's record rally shows cracks. What does that even mean? As most stocks left out. What it means is when an index fund goes up, it could be, it's possible that 10 stocks go up and 490 go down. So the S&P 500 is made up of 500 stocks representative of the American economy. There's no rule that says a certain number have to go up for it to go up. The way these indexes are constructed, and this is nerd alert, but we got to know it, it's not done. Each stock is not equally weighted in the index. It's weighted by the size of the company, or otherwise known as market capitalization, number of shares times the value of the shares. So yeah, NVIDIA is at the top, big chunk, and all the big companies are all there with it. The Microsofts, the Apples, the big ones. If they move up, and the little bitty companies all move down, doesn't matter. Index is still moving up because it's based on the size. They have something called equal weighted indexes, which were a really popular product 5 years ago, and now it's not popular like a lot of these products because it didn't work. But that's what this article is saying is, oh dear. This is supposed to be an article of a warning. So they're saying an equal weighted version of the S&P 500. That means, Amazon has the same weighting as this article says, News Corp, really small company. The equal weighting stuff goes down on a lot of these days. And it's the Magnificent Seven. Titans like Alphabet, Microsoft, NVIDIA. They're the ones that are really moving the market. And I've heard this complaint against indexing for about a decade now. It was about a decade ago. I was explaining to someone that I use index funds, and their comment to me was, hope you really enjoy owning a ton of Apple. You're pretty overweight Apple. Now, of course, we know this as listeners of the RHF Market Update that you're not overweight Apple. You're perfectly weighted in Apple. Whatever the index's weighting is the perfect weight. But that particular investor who was talking to me was thinking, oh dear, you're just buying at the top. You're just buying Apple at the top when it was the biggest part of the index. Well, we don't know. We're keeping it simple. But this is why it's so hard to be a stock picker and why most of the time it doesn't take me any analysis at all. When I look at a client's holdings and I see they've been using an active manager and they've maybe held with it for 5 or 10 years, I can almost always be assured with a 95% confidence based on the SPIVA report, they lag the index. And the 5% that do beat the index, they were overweight NVIDIA, or they were overweight one of these, or Tesla, one of these high-flying tech stocks, they were overweight. That's super rare. That's a 5%er deal. So when I read something like this that shows, hey, look, a lot of these stocks are moving down right now, a lot of them. And it's only these couple stocks that are keeping the indexes high. It doesn't bother me a moment. It's a feature, not a bug of the index, that these large companies would comprise the vast majority of the weighting. Feature, not a bug. So be happy and content with your simple plan. This relates back to the kind of the banks and the kind of Wizard of Oz curtain. And what do they have? What sort of investment solutions do they have behind the curtain? Nothing. And same with stock picking. It's nothing. There's nothing there. Don't worry about it. And kind of a follow on from this, there's a group called HFI Research. They're tracking how well value stocks are doing. These are stocks that are more stodgy old line companies like banks or an oil and gas company or an insurance company, as opposed to the high flying tech stocks like NVIDIA. Value stocks have been down 13 days in a row. This is as of December 19th. Can you imagine? You own a value index and you're waking up and you're 13 days in a row. And this is one of the reasons why I don't like picking growth or value. Just pick the bland market blend index. So if value does great. If growth does great. But if you start slicing and dicing the market, you'll start going crazy. Because you can read an article and guess what? And this happens, sometimes people will do a total value tilt. If you can keep it for 50 years, you'll be fine. It's so hard to keep for 50 years because of if it's down every day for the last 13 years. 13 days. But imagine 13 years. But let's say it's down every day for 30 days. Then you really start questioning your sanity. Have I forgotten how to invest? Are value stocks just never going to come back again? Don't do that to yourself. It's brutal. Keep your investing simple. And that's VTI, which is the ETF I like, or VT, which is the ETF I like, because Total Globe is VT. VTI is US. You're out of the arena. You're out of the game. You're just keeping your costs low. Invest simple, time rising long. It's wonderful. If you want to go to the insane asylum, and I was sitting next to a man at a luncheon, and he was in his previous work, he was a long short hedge funder, meaning he had a hedge fund. They would buy stocks, but also sell short, meaning companies they expected to go lower in value. So they were betting on stocks going up and going down in the same portfolio. And he looked, and someone asked him about his work, and he said, well, I had to leave the insane asylum. He even admitted it was driving him mad because stocks in the short run are manic, and he was trying to guess which way they'd go. And in closing, come into Robert's Corner. It's a wonderful day in the neighborhood. Won't you be mine? Would you be mine? Won't you be my neighbor? Good friend was asking me what books to read to educate himself on the 1920s, the Roaring Twenties. It was his belief that we are in an analogous time period, or maybe not his belief, but at least his thinking he could learn. And I sent him Reminiscences of a Stock Operator. And this is about a gentleman named Jesse Livermore, who was known as the greatest speculator investor of all time. He liked to short companies, and he wound up shorting the American stock market as it entered into the death throes of their great market crash, where it dropped 90% from 1929, 1932. He's got a great quote here. I want to read this to you. He says that, and this is a very sad story. This gentleman wound up taking his life, I think in 1934, but along the way was one of the wealthiest men in the world. He says this: money losses have never worried me in the slightest, but other troubles could and did. I studied my disaster in detail and, of course, found no difficulty in seeing just where I had been silly. He's talking about these past investments he's made. I spotted the exact time and place. A man must know himself thoroughly if he is going to make a good job out of trading in the speculative markets. To know what I was capable of in the line of folly was a long educational step. Oh, that's a great one. Put that on a pillow. I'll read that again. To know what I was capable of in the line of folly was a long educational step. I sometimes think that no price is too high for a speculator to pay to learn that which will keep him from getting the swelled head. I'm going to read that line again. Put that on a pillow. I sometimes think that no price is too high for a speculator to pay to learn that which will keep him from getting the swelled head. He continues, a great many smashes, that's kind of blowouts and zeroing out their accounts, a great many smashes by brilliant men can be traced directly to the swelled head, an expensive disease everywhere to everybody, but particular in Wall Street to a speculator. Now, let me just explain. I thought that was just a brilliant bout of wisdom that he did not always receive himself. When he's saying, I sometimes think that no price is too high for a speculator to pay to learn that which will keep him from getting the swelled head, he's saying, if you have a financial loss, but it keeps you humble, that might protect you from greater speculative folly and loss in the future. And he's saying a great many wipeouts, he calls them smashes, by brilliant men can be traced to the swelled head. So people that kind of somehow through some delay, they never quite got that humility, and it's an expensive disease everywhere to everybody. That's me, that's you. And this gentleman lived a life where he had all sorts of folly and all sorts of mistakes and did really well too. I forget the numbers, but it was this insane amount of money that was made. And he was constantly wiping out and making a bunch of money, wiping out, making a bunch of money. His time horizon was not long. His investing was not simple. But we can still learn from men like this. So oftentimes we can look back on our financial mistakes and lament them. I do it. Of course I do it. I lost in the late 90s all of my summer money, basically. I don't know, it was like $600 I bet on an internet stock called Internet America, wiped me out. I think that's part of what Livermore's talking about. He's saying, hey, not even too high a price. If that teaches you to get me the swelled head, so be it. And I've had to make multiple mistakes along the way. That was not the last, I'm afraid to admit. Many more along the way. But if it keeps you from getting the swelled head, oh, wonderful, wonderful, wonderful. Wonderful, wonderful. So don't look back and feel as though these mistakes are worth nothing. They can be worth nothing if you don't take advantage of the lesson, but be willing to look in the mirror, write down what happened as he's doing. He's spotting the exact time and place he engaged in folly and learn from it. And learn from it and develop a framework to keep you out of trouble. The one we got here is to keep your costs low, investing simple, and time horizon long, because that's what's going to give you the best shot on your investing journey. Merry Christmas to one and to all. Until next time.